So before we get started today, just a quick reminder for you, our team's here. If you've got any questions after the webinar, you're welcome to reach out to any of the members of the team, any of the advisors, myself, Katie, Lavia. Feel free to reach out to us if you want some more information on, how this fund is performing in your portfolio, or any questions about how we're using this fund in your portfolio. We're certainly here to answer any questions you've got. But at the same time, we want to encourage you to ask questions today and make this as interactive as possible. If you've been on our webinars before, you know that we like to mute everybody so that we don't have any dogs barking or any background noise. But to ask any questions, and we want you to ask questions, here's some quick directions. You're going to start by clicking on the small icon in the top right corner of your window. You can see it here. If you click on that icon, it's going to bring up some drop-down options. And if you click speaker, first thing that's going to do is that's going to make this full screen for you. Okay. And you're probably going to want it full screen just so you get a chance to see as much as possible. So if everyone would just take a quick second, click on that icon in the upper right-hand corner, click on speaker, it's going to change you to full screen and make it a little bit more pleasurable viewing experience. To ask questions, if you just take your mouse and you sort of run it over the bottom of your screen, you're going to see that ribbon come up on the bottom, and highlighted down there in blue is a chat box. And if you'll just click on that chat box, a window will come up on the right-hand side of your screen, and it will allow you to type in a question. You can type in whatever question you want, hit enter. It'll send the question to us, and we'll pause a couple of times throughout the conversation today to check for questions. And we want to make sure that any questions you've got get answered. So please don't be shy. Use the chat box to ask us any questions you've got today. So real quickly, we share this in every webinar. Just a quick disclosure, we are going to be talking about a specific fund today. We'll be talking a little bit about past performance. So just a quick disclosure to remember that past performance is no indicator of future results. So real quickly, just a second to discuss why we're holding this webinar today and why we feel like real estate is important. First and foremost are historical returns. And we're going to discuss some of the historical returns today, so you'll get a chance to see real estate consistently over the decades has been a strong performer consistently, whether you're looking at 10 years, 20 years, 40 years. Real estate's been a great contributor to the total return of all of our clients' portfolios. The second reason we love real estate is just diversification. And we'll actually talk a little bit more about this today as well. Real estate's a great diversifier from the global equity markets. Then we also love REITs, or real estate investment trusts, which is what the fund that you own invests in, because it's a very low cost, broadly diversified way for our clients to access the global real estate market. And we'll certainly talk more about that today. But for us, publicly traded real estate through REITs is just a really efficient, really low cost way for people to build a really broadly diversified exposure to the real estate marketplace. And then finally, just so you know, as we're going through this, in our portfolios that we manage for our clients, approximately 10% of a client's total equity exposure is in global real estate, and in fact, in the fund that we're going to be discussing today. So all of our clients own this fund, and it doesn't make up a huge percentage of their total portfolio, but it does make up all of their exposure to real estate. So we're excited for you to have an opportunity to learn more about what the fund owns, because we do think that historically there's been a bit of misunderstanding with clients about what they actually own when they think of real estate. Most people, when they think of real estate, think about, large office buildings in the core of downtown cities, or maybe they think about shopping malls or something of that nature. And we certainly own those as part of the fund. But one of the things we think that'll happen today is you'll get a much better understanding about how broad the real estate asset class is defined and the breadth of what you actually own. So with us today to lead this discussion is going to be Rob Harvey from Dimensional Fund Advisors. Rob is a portfolio manager at Dimensional Fund Advisors, and Rob's got a deep background on the portfolio management side with Dimensional. Rob currently is based in Austin, Texas, and he's a portfolio manager on international and emerging market strategies. Before that, Rob was managing both U.S. large cap and U.S. small cap strategies. Rob was also in Dimensional's London office on the London trading floor, managing international and emerging market strategies. Before Rob joined Dimensional, he was at Cisco Systems Treasury Department, managing both foreign exchange as well as the company's stock repurchase program. Rob's got an MBA from Cal Berkeley, and he's a CFA charter holder. So I just want to thank Rob for taking the time to join us today. If you give me just a second here, I'm going to turn the screen over to Rob, and we'll let Rob dive in and share with you more about the fund and the holdings of the fund. So Rob, I just turned it over to you. So hopefully you can share your screen.
Yep, that's great. Thank you very much, Mike. I appreciate that. Let's go ahead and pull up my slides here so we can get started. So thanks and welcome everybody, and thanks for taking the time to join us. Hopefully everyone can see this. Mike, is it coming through okay on your side?
Yeah, it's coming through great.
Excellent. Okay. Well, I'm not usually used to this sort of nice, warm reception that Mike has provided. It's not that REITs haven't done well, and it's not that we're not excited to talk about real estate, but sometimes, as Mike said, the attention gets grabbed by things like cryptocurrencies and, commodities and equities and what have you. But actually, not just from my own personal perspective, since I'm responsible for managing these funds, but real estate's actually an incredibly compelling and valuable asset class to have in a well-diversified portfolio. So we're going to talk a little bit about that and touch on the points that Mike talked about. So what is it that we're holding in these portfolios, the global real estate portfolios, and why? We're going to talk about performance. I know that's a very common question as well. But most importantly, when we go through these topics today, I've obviously provided, quite a bit of material, and we'll get to walk through that. Hopefully you find that compelling. But really, we want to make sure that we're answering your questions about this as well. So to the extent that you have topics on your mind as they're related to real estate or real estate investing, please go ahead, send them through the chat. We do have time to cover those. So I want to make sure that we address anything that's sort of outstanding with you. So with that in mind, let's go ahead and get started here. So global real estate, let's talk about the types of securities that we're investing in. Now, as Mike said at the beginning, we're talking exclusively about REITs in this portfolio. So we're calling it real estate, but we're actually exclusively investing in REITs. So REITs, real estate investment trusts, what are those? What is the importance of those? So for those of you who aren't familiar, the REIT structure, the term at least REITs, is something that's unique to the US, but the structure, the tax efficiency that REITs provide are actually something that many countries around the world are able to offer. And really the key point about REITs versus other equity securities that offer real estate exposure is that REITs, by nature of the fact that they are required to, number one, have underlying real asset holdings, so properties that they own, and number two, pass along the vast majority of their income, their taxable income, to end investors, that in conjunction with one another allows them to gain beneficial tax treatment. And that tax treatment means that they're not required to pay that corporate income tax on the income that they generate. They simply pass that along to investors. Now, obviously, investors have to pay, in their own income tax on those distributions. But you can imagine that without the restructure in place, you actually are getting taxed twice on the same distribution. Once at the corporate level for REITs, and then once as an individual investor. So the REIT structure is incredibly valuable because it protects more of that income stream for investors. And this is important to recognize about what's happening in this portfolio, because there are a lot of other different types of real estate companies. There are things like real estate operating companies and developers, property management firms. These companies can kind of diversify their assets away from real estate. They're not necessarily tied to this specific asset class, and also tied to giving all the distributions back, or most of the distributions back, to their investment pool. And so they don't really reflect that pure real estate asset class that we're targeting in this portfolio. So I'm going to move ahead here and just talk a little bit about what that looks like in terms of the asset class versus the rest of the equity market. So I mentioned before, real estate operating companies, for example, get picked up in other sectors. Here, what we're looking at is the MSCI World Index. So this is sort of a broad developed market index that you see. It's not something that we track, but it's just something that's informative. A lot of investors take a look at this index. And you can see, if you go sort of the fourth line from the bottom, you have a line for REITs here at 2.2%. So this is the allocation that the MSCI World places based on market capitalizations to REITs. Now, as I mentioned before, there are other real estate securities in here. There are, sort of a different line item for real estate down here, and other, types of GIC sectors and companies can invest in real estate on their own. But again, that pure real estate exposure that we're focusing on is approximately 2.2% in the MSCI World Index. Now, what we're talking about when we look at this REIT allocation is exclusively in the public sector. So all of these securities in this REITs allocation here are publicly traded. But of course, there's another side to real estate investing, which is the private side of real estate. And those are not obviously going to be reflected in an index, since it's not reasonable that people could go out and acquire those properties and sort of track an index. And that private sector for real estate is just as big as the public one. So if you were buying a portfolio and getting your real estate exposure through something like the MSCI World, your real estate exposure doesn't totally match and reflect what's going on in the private sector. And so at Dimensional, it's very important for us to be able to bifurcate the equity space from real estate. And so that, as Mike was saying, at Aspen, they can kind of customize the strategy to say, you know what, we actually want a little bit more real estate in our allocation, in our model portfolios, because we think that's a better reflection of the marketplace, or we think that offers diversification benefits. There's lots of different reasons that you might want to customize that sort of weight and holdings and REITs. And so by bifurcating them and breaking them out like that, it sort of allows investors the ability to change their allocation to the asset class, which is, of course, very helpful and valuable, and not something you're able to accomplish with an index. So we're looking at this sort of at a sector level, but let's drill in a little bit more and see sort of across countries and number of holdings, what are we actually looking at? And I think this diagram is particularly helpful. So obviously we've got a graph of the entire world. And what we're looking at here is all of the properties that we own worldwide. So these are not holdings that we have in the portfolio. The portfolio has around 500 securities that we hold, but each one of those REIT securities owns lots of properties, or has the potential to own lots of properties. And so by investing in the global real estate portfolio, you actually have exposure to over 200,000 properties across countries worldwide, developed, emerging markets, frontier markets, US markets. You kind of have this really great broad diversification to all kinds of different REIT industries, again, as long as they fit that classification of delivering that pure REIT exposure, which of course, as you talked about before, is so important. This is a good chance for us to talk a little bit more about the benefit of investing in REITs. So one thing that strikes me, and I think it strikes a lot of people when they look at a slide like this one, is just the sheer number of properties that you have across the different countries that we're able to invest in. If you compare this to private real estate investing, so let's say take your capital and buy maybe a rental property or two and rent it out, you're very exposed to anything that's happening in that local market, as well as this idiosyncratic risk of anything that happens directly with that property aside from the market around it. So if I'm in Austin right now and I could buy, maybe a property in Round Rock, well, I'm very exposed to, what's happening in the Texas market as well as anything, sort of natural disaster or what have you. When you have 230,000 properties across the world, you obviously aren't subject to that. And if one thing happens in a particular market, it's obviously not going to be devastating to the portfolio, or it shouldn't be, just based on the fact that you have quite a few securities. You can't obtain that through private real estate investing. So this is a massive advantage of investing in REITs through a mutual fund, as you are. Another thing that I want to talk about very briefly is the cost associated with public real estate investing through a mutual fund versus private. So you think about the cost of owning, the global real estate fund, you're talking about less than 30 basis points a year that you're paying for that portfolio to own, 230,000 properties, or essentially have ownership in them and be able to sort of get that exposure. When you talk about owning properties privately, there's obviously a lot that you're on the hook for when you own those properties, right? You get calls at 2 a.m. about, the water breaking or what have you. Those are all things that, have to be fixed and, kind of come out of your own pocket. And then to have a property management company oversee that is going to be expensive as well. You're talking about between 6 to 10% maybe for them just to be able to, clip that check for you and send it to you in the mail. They're just going to take their little bit out. So it's actually, from a cost perspective, incredibly efficient to be able to invest in publicly traded companies, because this is what they specialize in. As we'll talk about in a little bit more detail in a few slides, when we talk about what are the types of companies that we own in this portfolio, and Mike, sort of alluded to this earlier on, you'll see that they're very specialized. They are, exposed to a certain portion of the real estate market, and that's what they do, and they do it very well. So that efficiency that you gain also helps lower the cost a little bit. One other point I wanted to make on sort of the private versus public real estate investment that I think is important, and maybe some people don't think about, is when you have an investment in a publicly traded REIT fund like the global real estate securities, the income that you generate from those securities passes through to you, and you have an option of what you want to do with it. If you want to take that distribution, all of it or part of it, and do something else with it, spend it, save it, reallocate it into a different portfolio, you can do that. You can also reallocate it back into the global real estate portfolio. So if you want to maintain your exposure to real estate by using that income and reinvesting it, completely acceptable to do, very easy. It's much more difficult to do that in private investing. So if you think about, again, the example that I gave before, maybe you have 1 or 2 rental properties, the income stream that you generate from those properties, you can't just pour that back into another property, because it's sort of a step function, right? You need a lot of capital to accumulate before you can buy the next property. And so you kind of have to accumulate it and put that money somewhere else outside of the real estate markets, unless you're investing, sort of, again, through public equities, until you can accumulate that sort of that capital that's required for the next property that you're going to buy. And so this public investing also kind of allows you to avoid that chunkiness of properties. You can really customize and manage your REIT exposure exactly the way you want and put your money back to work the moment that you get it. That's a huge advantage, particularly when it comes to real estate, that maybe some people don't think about as much. All right, let's talk a little bit more about sort of country allocation and where your money is going, because obviously, as you can see on this graph, we have thousands of properties, hundreds of thousands of properties worldwide, but let's talk about the securities that we own. So where are the securities concentrated in different markets? And I think this slide does a good job of illustrating this. So we can see right away when we're looking at the country exposure, if you look at sort of the third column over here, the weight, that's the weight of our portfolio in these various markets. And if you look at the very top 2 rows, you have the US and Canada accounting for about 67% of the weight of the portfolio. So about 2/3 of the weight of our REIT portfolio is in North America. And that's important because, some people may sort of look at this and say, oh, it's quite a heavy home bias that we have. Actually, the REIT, if you look at the market capitalization of REIT of all countries, this is actually very similar to what you see if you just included all REITs worldwide and weighted them by whatever their market capitalization is. So when you look in the equity space, if you were to look at sort of, for example, the MSCI All Country World Index, which includes emerging markets, developed markets, and the US, you would see that the US accounts for about 54, 55% of the global equity market. So already we're talking about a big slug of that portfolio is in the US. In REITs, it's even a little bit more dramatic because of the fact, again, that we have this advantageous tax structure that not all countries have. And there's interest, and it's a very developed market in terms of real estate investing. So now we're talking about closer to 65%. And that's not to say we don't have global diversification. Of course we do. You can see all the various countries that we invest in. But it's important to note when you invest in global real estate, you are, by nature of the fact that it is a very developed and deep market, going to be primarily investing in the US. So the other thing I would just call out here is you can see that there is a blend of emerging and developed markets in here. But most of that is being concentrated in developed markets. So you look at, for example, Asia Pacific, your top two countries in terms of the weight of the holdings is going to be Japan and Australia. You do have China down here as sort of the second to bottom in the Asia Pacific region, but there's only 3 securities that we hold, and it's about 10 basis points of the portfolio. So if you recall, and actually I'll just sort of flip back here, if you look at the graphic here and the shading, you'll see that in China, we have somewhere between 100 and 1,000 securities in China, not securities, but properties that our REITs offer us exposure to, but we only have 3 Chinese securities. And again, that's because of the fact that REITs can invest outside of the country that they operate in or the security trades in. So we can gain exposure to lots of different countries without necessarily having to invest in them. So again, another benefit from investing the way that we do in REITs. Now, let's go into a little bit more detail about the types of securities that we own. So what is the business line that they operate in? And I think Mike touched on this earlier, and it's a very important point. And I think he's absolutely right. We get a lot of comments about real estate from people who say things like, well, I have a view on office spaces, the new work from home, sort of culture change where more people are going to be working from home and not occupying office space should decrease the demand for office space. And therefore, I don't really know if it's the right time to be invested in real estate because I kind of see that going down. Well, as Mike said, you do have an allocation to office space in the global REIT portfolio, but it's only about 11% of the total portfolio. So it's actually a relatively small part of your global real estate portfolio. And one thing that I want to emphasize here is that as the economy changes and as companies are changing the way that they operate, we've seen the real estate securities do the same. So we've seen a move like this technological shift that you see in equities and moving more towards a tech economy. That's also reflected in the global real estate portfolio as well. So I'll call that out, particularly when we look at specialized REITs, which is the top category here. A big component of specialized REITs is data centers. So, companies who have data centers don't necessarily have the specialization in investing in those types of properties. They may just want to lease those out, right? They may want to rent them from a company who does have the specialization, the expertise in running those properties. And so there are quite a few data center REITs that make up a fairly substantial portion of the global real estate portfolio. Additionally, you will see things like related to supply chain that are very important and make up a growing weight in a real estate portfolio. So, things like industrial warehouses. Imagine you're an Amazon or someone trying to compete with an Amazon. You have to have a warehouse pretty much in every locale worldwide. You're not going to have the capital or the expertise to be able to open up a warehouse in each one of those areas that you want to operate in. Instead, you're going to have a small space where you have a certain amount of your goods ready to be deployed. And most likely what you're going to do is you're going to rent that from somebody. So we'll take a look in a minute, but one of the largest REITs worldwide in the top 5 holdings is a company that specializes in doing exactly that. They help with supply chain logistics by offering space for companies who deliver or want to deliver, goods to clients, but want to do it on a short time frame. And so therefore they need space that's sort of close to the end customer that they can house some of their goods at. It's very important. Another thing is, people may not always realize what's going around them are REITs. So you see a lot of office buildings, and that's kind of natural to assume that that's a big part of the REIT portfolio, and it is. It's certainly a substantial part. But there are a lot of other things around us that you may not realize are REITs that are important components of the portfolio. One thing that I'll call out on the next slide too, in terms of the top 5 holdings of the portfolio, is public storage. So I'm sure for any of you who have spent time, going up and down the interstate, you've seen those big, orange signs with the purple, PS on them. Those are REITs. That's one of the biggest REITs out there. So this sort of cash cow where you have a big warehouse, people park their stuff in it, and they just pay you month after month after month. That's a REIT, and it's actually one of the biggest REITs in the world, is specializing in that self-storage area. Now, I'm talking about specialized REITs quite a bit, and one of the reasons that I'm talking about it is not only because it's the biggest sector in the REIT portfolio, but also because you'll notice it's a pretty big deviation from what you see in our portfolio versus the S&P Global REIT Index. So you've got sort of I'm going to say maroon, I'm a little colorblind, but the maroon bars here are stretching out far beyond the gray bars, which represent the index. So the maroon bars are Dimensional's portfolio, global real estate portfolio, gray bars, S&P Global REIT Index. And you can see that we have a substantially higher holding in specialized REIT than the index. And a lot of that is being driven by, again, a security type that people don't necessarily associate with REITs, and that is tower REITs. So cell phone towers. You think about Verizon, AT&T, Sprint, what have you. Those companies require 5G towers to operate successfully. They need those towers to be able to expand their network. They are not going out and buying those towers all across the world. They're relying on companies like American Tower, which is the single biggest REIT in the world by quite a margin, to provide them with those capabilities. So American Tower knows that business. They're specialized in it. It's everything that they do. And they own hundreds of thousands of cell phone towers and lease those to the major phone carriers who require those to be able to operate successfully. So again, just kind of one of those things where, again, when you think about sort of the technological advancements in the economy and the requirements that we place and the emphasis that we place on towers and sort of cell phone communication, REITs have adapted that as well. So specialized REITs have grown over time. Now, important to note here that with tower REITs and billboard REITs are just sort of, those things that you see as you pass down the highway that are advertising things. They're sometimes called advertising REITs. Neither of those are in the index. Both of those types of securities are in the portfolio. It's an important distinction. And when we talk about performance, it's going to definitely play a role. Those specialized REITs didn't used to receive that important tax treatment I talked about at the beginning of the presentation. So that REIT structure requires 2 things, as you'll recall. One is the holdings of real assets, and the second is that pass through of income that you're distributing to your end investors. And prior to 2017, those 2 types of REITs, tower and billboard, did not receive the real asset classification by the IRS that was necessary for them to be able to receive that tax treatment. And so as a result, both in our portfolio and the index, they were not included because they didn't offer sort of that pure real estate exposure, again, in the sense that you're being sort of unnecessarily taxed for this. I wouldn't say unnecessarily, but it's changed over time, obviously. So now in 2017, the IRS passed a ruling that said, okay, cell phone tower and billboard REITs are classified as real assets, and therefore they get this REIT treatment. And at that time, we added those types of securities to our portfolio. The index never has. So we would expect at some point that the index does. It's been years, it still hasn't happened. So sometimes we get comments about, our portfolio offering securities that are, difficult to hold or difficult to obtain. These are some of the largest REIT securities in the world. The reason that they're difficult to obtain isn't because of their liquidity or size, it's because the index doesn't hold them. So this is a massive advantage that we have in terms of that diversification. You can see, again, we're not making a bet on specialized REITs. This is just holding specialized REITs at market capitalization weight. Cell phone tower REITs account for quite a big part of the real estate market. And so I'll pause right here after this for questions, just to make sure we're not missing anything. This really demonstrates sort of exactly what I was talking about here. So 2 of the 3 biggest securities in the world in terms of REITs, American Tower and Crown Castle, are tower REITs specifically. So if you don't hold these securities, you're missing out on close to 10% of the REIT market. And of course, in our portfolios, we offer them, in the index, they don't. It also demonstrates, again, as sort of I was talking about before, the developments that we've seen in real estate to reflect the economy around them. So Prologis, for example, is that supply chain REIT that I talked about, offering warehouses and a company's ability to sort of get their product on the ground closer to their consumers. Equinix is a data center REIT, so I talked about the importance of those before. That's one of the top 4 biggest REIT securities out there in the world. And then Public Storage, as I mentioned before, is also another one. So you really see it's a lot more than just office space and residential buildings. There's a lot of depth and a lot of innovation, I guess, that's happening in the real estate market as well. All right, so I've talked for quite a bit at this time. I think it's probably makes sense to just take a brief step back and see if there are any questions that we can answer for anybody.
Rob, it's Mike. We have had a couple come through, and I'm hoping we're playing some games here with muting, but I'm hoping that your audio is still working, and it looks like it is.
Yep.
A couple of questions have come through, and again, folks, feel free to go into the chat box and type any questions you've got into the chat box. But we have had a couple come through. Rob, the first question was related to, back on your slide, I think it was slide 4, where you list the price to book across the different regions of the world. And some folks noticed that the US was trading at what looks like a pretty substantial premium to the rest of the world. Can you touch on, is that something that is normal historically, or maybe similar to equity markets? Are US markets simply priced more richly today? I guess maybe, should we expect them to look like the rest of the world, or is there a real good reason that they are more expensive?
That's a great question. So let's start. There's 2 answers to this, or 2 components to this answer. One is looking at the price to book ratio of the US in all equity securities versus the rest of the world. The price to book ratio in the US tends to be a little bit higher these days. When you think about the largest companies that constitute the equity space, they tend to be more in tech, your Alphabet, your Apple, all your FANG stocks, essentially. Those all trade at relatively high price to book ratio. So generally, when you look at the US, which is a sort of more of a tech industry than you would see some of these, developed and emerging markets, maybe that are a little bit more industrial, that's going to skew your price to book ratios, because those happen to be very attractive to investors right now. Those price to book ratios have blown out substantially over the last few years, and are focused primarily in tech and healthcare. So if you are the type of industry or the type of country that promotes that industry quite a bit, your price to book ratio is going to look very different. So that's part of it. Another part of it is the types of securities that you hold. So those tower REITs that I talked about, those are a massive part of the US in particular REIT portfolio. They're not as dramatic when you look internationally. So the price to book ratio of some of these biggest names are very influential over the aggregate price to book ratio of the US. So you think about, again, I talked about it before in the previous slide, or the next slide. The 2 top tower REIT portfolios out there account for 10% of the entire global the real estate portfolio. So those two securities and tower securities in general, having higher price to book ratios do influence the rest of the price to book ratios. And that's exactly what's happening as well. So it's a lot of those, tower REITs that tend to have those higher price to book ratios. We don't see as many of those internationally. They exist, but not to the size, not to the extent that we see in the US.
Great, thank you. Second question that came in was one with respect to sort of historic return volatility, and how might someone look at investing in public market real estate as opposed to private real estate with respect to just the expected maybe volatility of the holdings or the portfolio?
Yes, definitely. Let's look at that. Actually, that's a perfect segue if we're okay moving on, because that gets to the performance, which is the next part that I wanted to talk about. I think I saw someone very briefly put in the chat just when we got kicked off about 2008, what happened in 2008 with equities and real estate. So this helps address some of those questions, talking about public real estate investing versus, let's say, the rest of the equity market. So we're going back here to July 1st, 2008. So, very close to the depth of the crisis, if you will. And you can see exactly what's happened. You've got the green line, which represents the global real estate securities portfolio, and the blue line, which represents the MSCI World Index. You'll recall, of course, we did show you the characteristics of that before. It was about 2.2% of that index was real estate security, or REITs in particular. And of course, it's only looking at public securities. So a few things to note here. First of all, just to answer the specific question around 2008, absolutely true that REITs got hurt quite a bit there. So the portfolio certainly felt the impact of that, as you would expect. Equities did as well. So, we talk about REITs being a good form of diversification, a good thing to add into your portfolio to sort of offset some of the movements that you see in the equity space. Sometimes that doesn't happen. And something like the financial crisis, most asset classes, with the exception of some commodities and of course bond yields, did fairly poorly. So if it was a risk asset, which of course real estate is, it got hit. That sometimes does happen. So you see the same thing sort of happen around 2020 there. Obviously, we all know what happened there as well. So, in these sort of major crisis moments where you have, either the global pandemic or, the financial crisis, those moments, risk assets do tend to move together. But there's actually a lot that happens in between that. And there are other periods of time where equities and real estate perform differently. And I'm not even saying that, that real estate and equities perform the same, even in distressed situations like what we saw. You can see 2008, real estate did a little bit worse than it did, than equities did at that time, but it bounced back quite strong. And actually for the next several years, almost a full decade, you actually saw real estate outperform equities by quite a bit. And even when you saw sort of this, the pandemic come about, that real estate exposure dropped by more than the equity market did as well. So they do offer diversification. They don't move in tandem, although directionally, sometimes you see similar things when there's extreme circumstances. Doesn't always happen. But important to note here again that when you look at the way these two are moving relative to one another, sort of regardless of where they wind up, they are first of all both demonstrating an upward trend. You've had good returns in both of these, and second of all, they're not moving in lockstep, which is exactly what you want. That's what you want with a diversifying asset like this one. So this kind of just demonstrates that what you'd expect to get from a real estate portfolio is generally what you get. This kind of highlights it in a different light. This is looking at calendar year returns, because sometimes when you look at compounding wealth over time, some of those later numbers start to be skewed by what happened before. This kind of does a good job demonstrating what's happened in each individual calendar year. And you can see that there are periods of time where REITs have done incredibly well relative to equities, right? 2014 is a good example of that. And you can see periods of time where they haven't done as well. So 2013, you pair those two together, they look roughly the same, but in a year like 2014, you're very grateful to have that real estate exposure. And that's exactly why it's there. It's, again, that diversification. You can see they're really not moving in the same direction. I mean, obviously over time, they're both doing well, but that diversification impact is important. So with that, I did want to just move forward to talk about the performance of our fund as well, just in the interest of time. I know we're almost up, because it's been very good. So for those of you who have been invested with this portfolio for a long time, or even if you've been investing more recently, it's been a good experience. So if you look at the global real estate portfolio, going back, all the way to the since inception return, which is on the far right-hand side here, July of 2008. Now you can see that we've outperformed both the net REIT index and the gross REIT index. And I want to talk about this for 1 second because it's an important distinction to make. The net dividend index assumes that all distributions that are made from that index are taxed at the highest applicable rate. So it's essentially a worst case scenario that most investors will not be subject to. But it is giving you sort of a sense of, if you were taxed at that highest rate, what would your return look like by investing in the index? The gross dividend is exactly the opposite. So here, what you're looking at is assume that you're not being taxed at all. So there's zero tax rate applied here. So this is the best case scenario that, again, most investors don't experience. And you would expect the portfolio, most portfolios, to perform somewhere in between these. It's not reasonable to expect that you would outperform gross dividends over a long period of time unless you're able to generate that alpha. Now, you can see that in our portfolio, we have outperformed the gross dividends by quite a substantial margin, 30 basis points, and that's on an annualized basis. So it's been, again, a fantastic return there. But I did just want to take a moment to talk about why that is. So in our portfolio, what's important to keep in mind is what our objective is to offer a broadly diversified, low-cost approach to capturing that real estate exposure. So we're not trying to, make bets on which sector is going to do better than the other, or try to shoot the lights out by overloading, a certain security in our portfolio relative to its market capitalization weight. By and large, we're investing at market capitalization rates, but the way that we invest, sort of not being tied to reconstitution dates of indices and being cognizant of the costs associated with trading in markets, all of that adds up over time and should, of course, be valuable to investors. In this case, what you see, that sort of extreme outperformance that maybe you wouldn't have guessed from the beginning, is largely due to the inclusion that we've had of those specialty REITs I talked about, Tower and Billboard in particular, that the index didn't. So generally, if you look down this slide, sort of on a calendar year basis, you see that the global real estate portfolio performed between net and gross in dividend returns, which is sort of broadly what you would expect. But there are exceptions, especially when you go post 2017 and beyond, where Tower REITs have done particularly well. We talked about the fact that they're at higher price to book ratios. That is because of the fact that the price has soared substantially, and they've done very well. And having exposure to that area of the market has been beneficial. So it's not that we're making a bet on what specialty REITs are going to do, particularly Tower and Billboard. We're saying these are an important part of the real estate market. We need to own them. And it's been beneficial for investors. So we're happy that the returns have looked this way. That's fantastic. Not sure when the index is going to be adding them or if they will, but certainly something investors can be happy with. So I'll stop there and make sure we have time. I don't know if we have time for questions, Mike, but happy to answer them if we do.
Yeah, we do. We've got time. If anybody has questions, I've got one or two more here. And of course, if anybody has any, feel free to enter them in the chat box. Rob, one question that did come through relates back to when you were talking about kind of the pros and the cons of direct investment in real estate by buying, a physical property yourself versus the public markets. And there was a question around, is there any advantage around the cost of capital in the public markets with large institutions that may be able to access capital cheaper than maybe I could directly? Can you just talk about any advantages or disadvantages there?
Absolutely. And the advantage clearly goes to, sort of the capital markets that are able to be accessed by these companies. You think about what is the rate that you get to, take money out from your local bank. It's obviously going to be substantially different than if you're a multi-billion-dollar company and have lines of credit and, sort of lending facilities that you set up. You can issue debt, and pick the part of the yield curve that's advantageous to you. You can issue equity if that's sort of an advantage in your capital structure. So massive advantages in terms of the cost of capital for people to be able to invest. And we do see that real estate companies have been able to leverage that pretty successfully. It's sort of vastly different. It's not even comparable between public and private in that sense. So yeah, it's a great point.
Rob, just one last question before we let you go. And again, thank you for taking the time to walk us through this today. But some questions here again around diversification benefits of a public portfolio versus owning rental properties, which I think is usually the most common direct investment. Can you just touch on those again real quick and maybe summarize those, please?
Sure, definitely. So, I mean, maybe it's helpful to talk about an illustrative example. We'll kind of flip back up here. So, when you think of, and somebody had asked about 2008, which I think is, these are good sort of case studies to look at about the impact of diversification. And you think about what's happening in the development of real estate properties, sort of over the last, let's call it, 15 years or so. We've all heard the stories about these, current ghost towns that were massive developments in Florida and Nevada and Ireland and, all these different countries. And if you were an investor in one of those properties, you could have lost your shirt, right? That happens in some of the markets that you invest in. Thailand had massive flooding a couple of years ago that completely wiped out warehouses altogether and all the goods within it. If you're invested in one of those, you don't have exposure to real estate anymore. You have an insurance claim. So there's all these sort of, kind of idiosyncratic risks that come associated with individual properties, right? You're subject to whatever happens to that individual property. And if anything bad happens to that market or that property, you're on the hook for it. And that's your real estate exposure. When you have this broad diversification across all these properties worldwide, I'm not going to say it doesn't matter what's happening in Florida and Ireland and what have you. It has an impact. But again, it's what real estate as a whole globally is doing. And that's really what you care about as an investor. You're not interested in, what this block in Houston is experiencing because of the flooding. You're interested in what is really the global portfolio of real estate doing. And that's what you want, again, through that exposure. And that diversification is so important in that sense because, not only is it difficult, and I would argue impossible, to be able to consistently guess where the hottest markets are going to be and place your money there. And, aside from all the costs, which we haven't even covered, I talked about that earlier. Not only is that sort of incredibly difficult to do, but it's also very time consuming, right? That's a full-time job. You have active managers out there who do that as their, entire job. So the diversification impact is huge. And then, of course, again, as I said before, in terms of the cost, we talked about financing, we talked about, property management companies, of that individual property repairs, all that. These REITs that operate, this is what they do. They have, staff on hand to handle all this. They're incredibly efficient at being able to handle whatever comes up in those properties. You can't compete with that scale as an individual investor sort of investing in private real estate.
Rob, last question, actually an excellent late breaking question here. So if we think about the environment we're in right now, with a lot of folks concerned about both rising interest rates as well as higher inflation, can you talk about how they might think about a public real estate portfolio and the pros and cons of how real estate might benefit or be hurt by both inflation as well as potentially higher interest rates?
Definitely. It's a great question. When we talk to investors about investing in real estate, there are oftentimes, as I said at the beginning, multiple different reasons why they would want to be invested in real estate. Some of it is, sort of that it's global holdings and they want to represent a global portfolio. Some of it is income, right? You want to have sort of the upside of appreciation of property, but you want to have some income as well. Then there's this other aspect that this is touching on, which is the performance of real assets in the face of inflation. One of the things I didn't talk about at the beginning, just in the interest of time, was the fact that not all REIT securities are included in the portfolio. So we're only investing in REITs, but not all REITs are included in the portfolio. And they're also not included in the index. Things like mortgage REITs, for example, are not included. And the reason that mortgage REITs aren't included is because we found that they are particularly sensitive to interest rates, as you'd expect. When you talk about mortgages, you're dealing a lot with prepayment risk, and that sort of optionality embedded in mortgages. That is largely being influenced by where interest rates are going. When you look at real estate, interest rates are certainly a component because that's informing, so inflation is informing how much you can charge for rent, right? So that is an important aspect. But you also have to look at the appreciation of the properties that are owned and sort of the demand for that. And what we've seen is that real estate is a very attractive place to put your money if you're concerned about things like inflation. I'm not going to say it's entirely protects you against it or that everyone should pile into it, sort of if there are inflationary concerns. But if you compare real estate to commodities, which is a common place that people also talk about sort of, parking their money in the high inflationary, or if there's risk of inflation, I should say, commodities are really just all about supply and demand. There's no sort of natural appreciation that happens in commodities. Real estate's quite different from that. So you sort of have all these advantages of, the appreciation that we saw. I'll just flip down to it here. Over time, even after periods of difficulty, commodities don't really look like this. Commodities look sort of more flat, as you'd kind of expect. Now there's ups and downs, of course, but sort of this upward trend that we've experienced in real estate is more similar to the equity market, but again, sort of helps you protect a little bit against those high inflation environments because of that real asset component.
That's great. Thank you, Rob. And again, Rob, I want to thank you for joining us today. A great presentation. Thank you for the insights. I just wanted to share with the group one last thing before we move on. We are planning one last webinar this year that we think you'll find quite interesting. We're going to be working with the folks at Charles Schwab to have a fireside chat with clients on cybersecurity. This is really intended for you as individuals and how you can structure your home, your phones, your laptops, your home internets to make sure that that you're doing everything you can to keep your personal information and certainly your financial information safe from hackers. And we think you'll find it most interesting. So please make sure and put on your calendar December 6th. So in roughly a month at noon Mountain Time, you'll be getting some information from us as well. But we will be hosting our final webinar of the year on cybersecurity. So with that, Rob, again, I want to thank you for taking the time to join us. We will have a recorded version of this if you'd like to listen to it again. If you've got a friend or family member that you'd love to forward it on to that you think would benefit from it, please feel free to do that. And of course, if you've got any questions for your advisor here at Aspen Capital Management, just reach out to us. We'll be happy to talk to you. So thanks again and have a great afternoon.